So we have talked about balance sheet and then how to record transactions in double entry accounting. But most of the transactions that I've been showing you have been really in the area of balance sheet. It hasn't been anything about the company making money. Now we're going to move into sort of the next statement, financial statement, and talk about income. And really income is about how the company's making money. And this money is being made for the owners. So any way that we make a profit, that goes right into equity and into the particular account called retained earnings. So I'm going to show an example of how this works. Initially, about how things are transferred from the assets or liabilities into a profit-making, the profit-making of equity. So this is an income statement. So first let's look at it. Oh, wow, this is 20,717. That's the month. But the point is that it's for a month of January, not for a point in time, but over a period of time, how much money we made for that period of time. They're going to be reporting revenue, which is income to the system, things that we sold, ways that we generated income through consulting or services. And then you're also going to have expenses. So all the expenses associated with getting that revenue, rent, cost of the goods sold. So if you sold items, they have an initial cost to you where the profit comes in. You had to pay insurance, utilities, advertising, whatever it is, you'll have the total expense. And the difference then is the income to the corporation. Now that's a general accounting statement, an income statement. I'm going to go ahead and show you how those values are entered, how each of these line items would be entered into the T accounts and show where it ends up in assets and equity. So the first way we're going to do this is we're going to set up a balance sheet because we want to get the account balances for the particular accounts that are affected. So you can see here I had cash balance of 1,000, I had retained earnings of 3,000, and then I have an account that I'm just calling all other accounts, just so that I have a balance of debits and credits and all my my assets or liabilities plus equity. So the first transaction is that we sold $2,000 worth of software for cash. The cost of the software was $500. So you can see I have actually 4 entries here. I sold $2,000 worth of software. That's where I get cash of $2,000. And then I actually entered it over here as an increase in the equity of $2,000 because it's part of the owner's profit. The other side of it is I had a cost associated with that I purchased those in, and I'm just going to assume they weren't in inventory, that I just purchased them during that month. So I had a cost of that of $500, and then also I had a negative effect of earnings, so that this profit of $1,500 is showing up in the owners. It also is showing up in cash, but it's showing up in the owners. The next one is I paid rent of $400. Again, that's a decrease in cash and an increase and a decrease, in equity. The $50 for the insurance, the $150 for utilities, the $100 for advertising. And that means then when I calculate these balances, I now have $1,800 in cash and I now have $3,800 in retained earnings. That $800 increase from $3,000 to $3,800, it corresponds to this income. So what the income statement tries to do is to summarize all this activity within retained earnings. And also we want to see that actually all that went into cash. It doesn't necessarily have to go into cash, but in this example it did because all the items were paid in cash. So an income statement reconciles the change in retained earnings. Now, usually in a company, there's a whole bunch of transactions that have to do with income statements. So what we generally do is we actually take all of these items, all the expense items and the income items, and we split them into 2 different categories that we call income. Just like there's equity, liabilities, assets, we also have income and expense items. So I'm going to show the same example and show how we would do it if we were going to be including all of the 2 other types of T accounts, incomes and expenses. Right here, I've set up the 5 types of accounts, the T accounts that you're going to be used when we expand the equity account into both income and expense accounts. So unlike the previous ones I was doing, I'm going to record incomes in one type of T account and cost of good and expenses in another type of T account, instead of putting them all into retained earnings. So what I have is the same sort of setup I had previously. I just wrote it down here. I have cash at 1,000, and I have equity at the return on equity at $3,000. Okay, so what I have here is I'm going to start recording these expenses. So the first one is that we sold items for $2,000. Now, we're going to have, this is going to be an increase in equity, so it's going to be a credit entry, and I'm going to go ahead and write $2,000 right there. But we also had cash associated with it, so I have to put it over here. That's the double entry, first in sales and then in cash. In addition, it had a cost of those, there was costs associated with those items, and it was $500. So I'm going to put $500 here, and then it decreased cash of $500. The next one is I paid rent, and so what I'm going to do is I start to actually create new T accounts that correspond to the expenses. So I have rent of $400, so I put it here as another expense category, and then I decrease the cash account by that same amount. Insurance, I'm going to make another expense account for $50 of insurance, and then decrease cash. Utilities of $150, I just put it there instead first. Utilities of $150, and then the last one is advertising of $100, and advertising of $100. Now I'm going to go ahead, and it's going to be the same change in this cash account, and it's going to be $1,800. It's the same as I did before. But what's different here now is I'm going to go ahead and close all of these accounts initially. Whoops, 2,000, 500, 400. And really, these lines across are actually pretty important, especially when you're going to be doing something on the tests, because I want to know that you actually understand that you're done, the accounting cycle's done, you're done entering values. Now, what's the problem here is we have all of these expense and income accounts, and those don't really go on the balance sheet. So what actually ends up happening is we have to close out those accounts. And the way we do that is we create another account that's under equity. It's called income. And what this is going to do is double entry wise, it's going to record both the income values and the expense, values and the expense values into an income statement. And we're going to do double entry accounting. So first of all, look over at sales. I'm going to enter $2,000 sales there. Now that balance is zero because there's 2,000 on each side. And that was a debit entry. And then I'm going to put $2,000 here as a credit entry into that account. That closes out that account. I'm going to do the same thing for cost of goods sold. So now that closes out that account. For rent, closes out that account. Insurance. Now this is very much the same as I did previously, but I had everything closed into retained earnings. This is just a different way of keeping track of things a little bit better. So now we're going to close this, and this ends up being $800. That is the income. So this particular account is actually very much the same as the income statement, right? But it is in an account. So actually there's one more thing we have to do, because there's no such thing as income account on the balance sheet. We actually have to also close this account out into retained earnings. Now that balance is $3,800. Everything else is zero. All these other values are zero. All these accounts are actually equal to zero balance. So they don't go on they're not going to show up on the balance sheet. These ones will, but we will have the detail associated with that. So we know we can trace our steps on that.